In this week's video, we'll review the latest charts and data to help us understand how things are holding up as the bull market reaches its moment of truth. We'll be moving quickly, so feel free to use the pause button on your video player. There are no shortage of things to worry about in the present day, including a new development this week with escalating tensions in the Middle East. We had another week with wild intraday volatility, and yet, much like a week ago, it may not feel that way, but the S&P 500 finished this week up 19.28 points, and last week, for the full week, we were up over 20 points. This is relevant as well. The U.S. government had a poor showing at this week's bond auction, and you might think that credit spreads spiked after Thursday's session. It's not the case. It's the chart that we've reviewed over and over and over again, and this is after Thursday's session. If we're trading the chart in front of us and the data set in front of us, this is what we've got to work with. There are numerous ways to look at credit spreads. This is one here. Another commonly used measure, also tame. Pulled all three of these charts after the close on Friday. The Chicago Fed National Financial Conditions Index in the 70s, when there's all kinds of problems with oil, issues in the Middle East, credit conditions were much, much worse than they are today. Keeping in mind the VIX hit 25 in Q1 of this year, meaning we don't want to get overly concerned about a move above 20, but there's no question, if we see a weekly close in this area here, this weekly chart of the VIX moves from being not particularly concerning to somewhat concerning. And then if we exceed this high here, it would move to concerning. So we're not making any assumptions. This is the chart in front of us this week. This is the area here and the area here, the region of potential resistance that we've talked about for several weeks. There's more information about the VIX being somewhere in the neighborhood of 19. In this post, you can find it on our blog. It's the chart that we covered in the August 18th video. Where do we stand today relative to these areas of potential support? The easy scenario from here for the stock market bulls, this looked good here. This looked good here. Getting to the other side of this band here. This is starting to look more concerning now. Nothing particularly alarming, but the need to have defensive contingency plans in place would increase if we take out this October low here. We held there earlier this month, and this is still an important area. Somewhere in the neighborhood of 42.01 is the 200-day moving average. On a closing basis here, this October low, 42.29. Key area C here, this is the intersection of the anchored volume weighted average price line that comes from the 2022 high in early January of 2022 and the October 12th, 2022 S&P 500 low. It's fair to say this entire move here, this entire breakout, starts to become a lot more suspect if the S&P 500 can't hold this level here, or if it overshoots it, you don't want it to do so for a long period of time. Quick stay below, not that concerning. So if you move into this area here, this white space, the longer you stay there, the more concerning it would become. We should keep in mind, earlier in the year, we did make a stand near this line here and this line here. These are the anchored volume weighted average price lines tied to the COVID high and the COVID low. It would be very concerning about the big macro picture if the S&P 500 trades below those two lines and stays there for any length of time. It's relatively easy to remain patient if we hold this low. It gets harder if we take out this low. The need for defensive contingency plans will increase if the S&P 500 cannot hold this region in here. And concerns related to a very significant drawdown would increase if price exceeds these levels down here for any length of time. And what do we mean by that? Drop below it for 1 or 2 sessions, not that big a deal. A couple of weeks below these lines, very concerning. Now, having said all that, thus far, price has bounced near a very logical area. Not making any assumptions about what next week looks like. This is the chart in front of us today. It's not overly concerning. It's starting to become somewhat concerning, and we're going to respect that. A handy little table here from Bloomberg, which passes the common sense test. The more confined the conflict is, the lower the impact to oil prices and potentially the hit to GDP. If the war expands into other regions and brings in other countries, it could be very significant. At the moment, we're up in this area here. And we should keep in mind, if we can hold this region in here, and more importantly, this band in here, and this conflict remains relatively confined, and interest rates calm down, the door is still open to a very significant and satisfying rally between now and year end. Moral of the story here relative to inflation. If you understand how CPI is calculated, the shelter component tends to lag. Had a lot of that in here. You can see the housing component is starting to roll over. This is core CPI, the light blue line, if we take out housing. And there's no question the rental market has softened significantly. Thus, there's a chance that inflation could exceed expectations in the next 1 to 6 months. Right now, it's still an issue. At the moment, the data sets in front of us, the charts in front of us, we really don't have a problem with this first bullet point here. Pulled these charts off of Fred during Friday's session. At the moment, these key data sets look fine. And relative to this and this, a lot of intraday volatility, but all of this over here, relative to the primary trend, still in play, still checking everything in a yes and green fashion. Interest rate induced volatility in the markets. We've been saying for a long time that we better get used to it. We saw more of it this week, including during Thursday's session. Stocks were doing just fine, and then there was a very weak Treasury auction in the afternoon, and stocks reversed sharply. They did regain some traction before the close, but it's a reminder that we're in a new environment. As we all know, the 10-year yield has been rising rapidly, and the concept of a term premium is coming back into play. Article dated October 3rd, 2023. Why does term premium matter? It's another sign the era of slow growth, low inflation, and easy Fed policy that followed the 2008 financial crisis may be behind us. Let's move to this bullet point. The relative moves in the bond market reflect growing confidence that the U.S. isn't heading for a recession, and rates will be higher for longer. Now think about this. The era of slow growth, low inflation, and easy Fed policy is OVER. And the recent moves in the bond market speak to growing confidence that the U.S. isn't heading for a recession. Does all of that align with or contradict the topics that we've been covering in recent weeks and months? So let's take a look at the Ichimoku clouds to see how much damage has been done thus far to the market's intermediate term trend. In a past video, we covered these topics in detail. Let's just do a quick review. Major bear market, 1973-1974. We want to understand what the transition looks like from a bear market back to a bull market. If we skip ahead to the dot-com bust bear market on the bullish side of the ledger, up here, the green span above price, price above the red span, price is above the cloud, and the cloud has flipped from red back to green. All of this is discernibly different from this. Here are the same concepts at the turn at the end of the financial crisis. The S&P 500 bottomed on March 9th of 2009. This over here looks substantially different relative to this over here. Thus, in the context of all the recent volatility, where do we stand? The short answer is we're still in pretty good shape. Green above price, yes. Price above red, yes. Blue above red, yes. Price above the cloud, yes. So what does this tell us? It tells us thus far, this is classified as a normal pullback within the context of an existing weekly uptrend. And obviously, in the subsequent days and weeks, if we start checking these boxes, we would learn something about increasing bearish probabilities. And as always, we want to trade the chart in front of us while remaining open to a wide range of outcomes. Commentary in this week's video speaks to the data and the charts that we have in hand. If there are material changes induced by rapidly rising interest rates, then we have to be willing to reassess the probabilities. All of these charts dated October 12th. Triple Qs checking all the bullish boxes. Semiconductors checking all the bullish boxes. XLK checking all the bullish boxes. Vanguard Growth ETF checking all of the bullish boxes. Looking more vulnerable? Yes. Significant damage? Not yet. Leveraged read riskier loans. 2022, we're checking all of the bearish boxes. Present day, checking all of the bullish boxes. The look of this chart aligns with this statement here. Growing confidence that the U.S. isn't heading into a recession. Because if we think in extremes, risky loans probably going to be the first ones to default. And SRLN, for the most part, 100% corporate bonds. No AAA, no AA, no single A. That's where the concept of riskier comes into play. And the trend in this ETF is still a confident look. JNK this week, not as strong as some of the others. Green, relatively close to the cloud. But there's no question the look over here looks significantly better than it did in 2022. And we've talked about this in the past. This improvement from over here to over here, it's been relevant in the past. After the major low in 2009, after the major low in February of 2016. This and this look similar to this. And this looks significantly different relative to 2022. QQQ relative to RSP, the equal weight S&P 500, this looks like a bullish breakout, consolidation, a retest, and then a higher high. This ratio is checking all of the bullish boxes on the weekly cloud. If we look at QQQ in isolation, the retracement of this A to B decline, a normal retracement within the context of an existing downtrend might go back to the 38.2, the 50, or the 61.8, and then if the downtrend remains intact, you'll go on after that retracement and make a lower low. When you get to the other side of the 61.8, the longer you stay over here, the higher the probability that this is indeed a trend reversal from a downtrend to an uptrend. All of this consolidation thus far in recent weeks and months occurring above the 61.8 retracement. Weekly cloud QQQ in isolation, still checking all of the bullish boxes as of October 12th. 1 to 3 year Treasury bond speaks to Fed expectations. This is 2020 over here, checking all of the bullish boxes on the weekly cloud. Then we get the transition in here. The NASDAQ peaks Q4 of 2021. And the S&P 500 bottoms down here in October. The NASDAQ bottoms in December of 2022. And you can see the look of the cloud here significantly different relative to the risk-off look here in 2022. Similar look with SCHO, the Schwab short-term U.S. Treasury ETF. And if we look at the moving average cluster for SHY here in 2022, the 250-day moving average, the slowest moving average, is on top. Now we've transitioned here from a downward sloping 250-day to an upward sloping 250-day. Probably fair to say this looks significantly different relative to this. SPY monthly. So this speaks to the long-term trend. This is the improvement after the major low in 2009. There's no question the present day looks more like this relative to this in 2008. Blue drops below red here in 2008, recaptures it after the major low, and a new bull trend is in place. Present day. We drop below in the rearview mirror, we're back above. During the risk-off period in 2022, checking all the bearish boxes. This week, October 12th, checking all of the bullish boxes. VUG relative to VTV speaks to growth, interest rate, inflation, and Fed expectations. This is XLK relative to SPY. You can see blue clearly recaptures red here in 2016. This looks similar to the present day. And after this in 2016, really good things happened in the ratio. Similar situation here after the major low in 2009. Blue clearly above red down here, and the ratio rises for a long period of time. During the financial crisis, blue clearly below red. This really doesn't look anything like 2023. Cloud ratio chart XLK divided by XLP consumer staples. This is a chart up here, a segment of the chart that we covered. It's dated June 27th. We showed improvement on this ratio cloud. Things look even better today. Here's this high. Now we've exceeded this high. NASDAQ peaks here. Full bore bearish look on the cloud. Present day, the ratio clearly, unequivocally has a full bore bullish look. Green above price, yes. Blue above red, yes. Price above red, yes. As the cloud flipped from red to green, yes. This is what fear looked like in 2022. This is what fear looked like during the COVID plunge. This is what this week looks like as of Thursday's close. Over the past 12 to 24 months, it's not been unusual for the Federal Reserve to deliver messages to the market via Nick Timiraos and the Wall Street Journal. Thus, it's noteworthy. Story dated October 10th. First paragraph only has one sentence. It's over here on the right side of your screen, and it's important. A sustained rise in long-term Treasury yields could be bringing the Federal Reserve's historic rate hiking cycle to an anticlimactic end. Also noteworthy, October 10th, China is considering raising its budget deficit for 2023 as the government prepares to unleash a new round of stimulus. Speaks to adding liquidity to the global system. A long-term breadth-related signal. Nothing particularly new here, but it's still noteworthy. .com bust bear market, lower left-hand corner of your screen. The signal never fires during the bear market. 2008, signal never fires. 2021 into 2022, never fired. Signal has fired several times now, telling us most likely this was a major low. The extremely broad S&P 1500. Regardless of what happens over the next few trading sessions, this is an area of potential support and strong potential support. At the gap up here, you can see it in June of this year, came back to the gap and thus far have held. It's also noteworthy that this gap up here in June is basically the exact same area where we had the gap down in 2022. In this week, price trying to make a stand at a very logical area relative to the anchored volume weighted average price chart. VWAP up here tied to the 2021-2022 highs. VWAP down here tied to the October 2022 low. It's another visual representation of, regardless of what happens in the short run, this band could act as potential support and potentially strong support. We'll learn something if we bounce and move in this direction, and we'll learn something if price gets down into this area here. Covered this ratio numerous times, and it's also covered in detail in this Seeking Alpha post. You can Google the title on the bottom of your screen. This is the look we want to avoid, a rollover look. If the economy was about to tank and or we were about to enter a severe debt crisis, most likely what would happen? The Fed would move closer to lowering interest rates. And corporate earnings most likely would be getting ready to take a big hit. If both of those bearish scenarios are about to play out, it's unlikely that we would get a multi-month breakout in the ratio, and thus far the bullish breakout looks like it's consolidating in a logical and bullish region. Very, very similar concepts here. The S&P 500 rallies, gets extended from an upward sloping 30-week in blue, and thus far has come back and tagged the 30-week and is trying to rally. Talked about this concept with the VIX numerous times in weekly videos. It's also covered in a recent Seeking Alpha and/or Short Takes post. What once acted as support, what once acted as support, what once acted as support in 2022 may now act as resistance in 2023. This is a weekly chart. Exact same concepts on a daily chart. You can see the VIX holds. It acts as support. The S&P 500 takes another leg down in 2022. That region acts as support. The VIX bounces. The S&P 500 takes another leg down, risk off in 2022. Almost the polar opposite this week. You can see the VIX comes here and turns up. VIX comes here and turns up. Thus far, VIX coming back to the same region and turning down. A lot of charts in recent weeks that look like this. Bullish breakout, retest look, coming back to this gap, and thus far we've held. All of this occurring above an upward sloping 200-week in red. Software stocks 2004 40-week moving average in blue crosses the 200-week moving average in red. Good things happen in the S&P 500 for a very long period of time. Bottoming process 2008, 2009 S&P 500 bottoms on March 9th of 2009. The exact same blue 40-week moving average recaptures the 200-week moving average in red, and good things happen for a very long period of time. October of 2023, the same blue 40-week moving average trying to recapture the same red 200-week moving average. What once acted as resistance, has thus far acted as support. This is riskier and higher yielding corporate bonds LQD divided by more conservative and lower yielding IEF 7 to 10 year treasuries. S&P 500 makes a major low early 2016 here, and then stocks rally for almost 2 years. Here's the risk on look in the ratio. This is what the present day looks like. S&P 500 after the COVID low, risk on. This is what the ratio looks like. Risk off, and here, this is what the ratio looks like. S&P, a lot weaker. In here, market a lot less confident about future economic and market outcomes. Credit markets look discernibly different over here, 2015 into this low in 2016, relative to what we have so far in 2023. The NASDAQ peaks in Q4 of 2021. This is the NASDAQ Composite Tracking ETF 1Q relative to RSP, the equal weight S&P 500 index. Moral of the story, this is risk off here in calendar year 2022. You may remember the NASDAQ bottoms very late in 2023, and the ratio starts to take on a discernibly different look. Present day, slowest moving average, the 250-day moving average down here, is on the bottom. 2022, exact same moving average is on the top. So far, this looks like a left shoulder, a head, a right shoulder, a bullish break above the neckline, a nice run, consolidation, and then a push higher. Similar concepts here, leadership shift, QQQ relative to SPY weekly. You can see in 2022 we undercut the 200-week moving average, but it's noteworthy. The slope never rolled over. Now we've recaptured this downward sloping trend line. We're back above this trend line here. We've recaptured the upward sloping 200-week in red, rallied and made a significant higher high above this level, consolidated, and now are trying to print another higher high, all of it above an upward sloping 200-week. Triple Q's weekly, 30-week moving average in blue, 40-week moving average in red, and the 50-week moving average in green. This looks discernibly different from this look here in 2022, and this looks discernibly different, almost the polar opposite of what happened here in May of 2023. Thus far, this looks like a rally consolidation above the moving averages, MACD down here, a bearish cross that occurs above the zero line. Mathematically, this is treated as a counter trend move within the context of an existing uptrend. That would change if black here dropped below zero, but as you can see, we're not particularly close to zero at this time. SCHX, very, very similar to SPY, but a little bit different composition. You can see the ratio of SCHX to SPY rallies here and recaptures the 50-week moving average in blue, and good things happened in the S&P 500 down here. You can see the moving average goes from a downward sloping look to a flattish look, and then an upward sloping look, similar to this look here after the major COVID low in 2020. It's probably fair to say that this look here with the flattish moving average is similar to this look here in 2016, and it's noteworthy. This is a period of consolidation in 2016 after the major low in February of 2016 here. S&P 500 peaks here. You can't see it on the screen. It's October of 2007. 2008 is the financial crisis. The ratio of shorting the S&P 500 SH to SPY above the 50-week moving average here, and the 50-week turns up in a risk-off manner. This really doesn't look anything like this, where the ratio is below a 50-week moving average that's rolling over in a bullish manner for SPY. This is a risk-on look here, drops below the moving average after the low in 2010, after the low in 2011, after the low in 2016, and after the COVID low here in the present day. Covered this chart many times. SP low volatility relative to SPY. The 20-day moving average in blue moves from the bottom of the cluster in Q4 of 2021 to the top of the cluster in Q1 of 2022. Bad things follow in the S&P 500. This look here and this look here are almost polar opposites. Q1 of 2023, blue goes from the top of the cluster to the bottom of the cluster, and since then, for the most part, good things have happened. Probably fair to say that this over here, October of 2023, really doesn't look anything like this period here in 2022, and this is the risk-off look that we want to avoid. Short-term corporate bonds in the ETF world, it's S's and Sally, P as in Paul, Sally, and Bob. Calendar year 2022 starts here. This is your risk-off look. It's discernibly different from the look that we morph into after the S&P 500 makes a low in October of 2022. During the recent period of consolidation, we're still holding on to a very favorable and, for the most part, full-bore bullish look, the mirror image, for the most part, of this full-bore bearish look over here in 2022. A lot of charts look like this. Long-term period of consolidation, a bullish breakout, and this looks like a retest. If we can move back into this area here, it will be deemed a successful retest. All of this is occurring well above an upward sloping 250-day moving average in black. Very similar concepts here. All of this is occurring above an upward sloping 250-day moving average in black. All of this is occurring on the third chart above an upward sloping 250-day moving average in black. If you're familiar with the fan principle, trendline break number 1, number 2, and number 3 here. So risk-off profile over here. We're still holding on to a risk-on profile. Already looked at a chart of the S&P 500 similar to this chart here. Also noteworthy, Microsoft, a major and important stock from the tech sector, has been consolidating above an upward sloping 40-week in this case. SPY's momentum down here in October of 2023, trying to take on a similar look to October of 2022, and after that, good things happened. TLT weekly, this is the price of TLT here, the red line. There's a Bollinger Band here, the thinner blue line. Heavy selling pressure here in October of last year. We're well outside the lower Bollinger Band. We recapture the lower Bollinger Band, and TLT eventually rallies for several months. And all of that occurs out of an oversold condition. This is TLT's RSI. All of that going on near the major low in 2022 in the S&P 500. This is October here. Trying to nail down a similar setup in the present day. RSI, the weekly chart for TLT, coming out of oversold territory above 30. We were below the lower Bollinger Band on price, and now we're trying to recapture it. US dollar bull ETF, UUP relative to SPY, the S&P 500 ETF. It's a weekly chart. This is the 200-week moving average shown in red here. See, the ratio moves away from a downward sloping 200-week moving average in 2016, just as the S&P 500 is making that major low in Q1 of 2016. Similar look here, but a little more pronounced. In this case, we overshoot the downward sloping 200-week moving average in red and eventually move away from it as the S&P 500 is bottoming at the major COVID low in March of 2020. We have been and continue to make the argument that this look here in 2016 and this look here in 2020 is very similar to the look from October of last year, and the ratio, for now, remains below a downward sloping 200-week in red. I believe we showed this chart earlier in 2023 when it was just trying to break out. This is global stocks, the exception of the United States, which is another way of saying foreign stocks. VEU relative to long-term treasuries TLT. In a consolidation box, moving sideways for 15 years. And markets move in fractal patterns, which means this consolidation in this 15-year box, for the most part, is the same if this were a 15-minute box. This is a period of indecisiveness and confusion, and now it appears that we're breaking out to the upside. The longer a market goes sideways, the bigger the move that you can expect to get when you either get a bullish breakout or bearish breakdown. In this case, it looks like we're getting a bullish breakout, and we're also getting the 40-month moving average in green crossing back above the 50-month in blue. The longer the breakout holds, the more relevant it becomes. But a breakout from a stock-bond ratio chart from a 15-year consolidation pattern seems to be relevant. And common sense would tell us something significant is most likely happening in the present day to cause this breakout. That was unable to occur in 2011, couldn't even get near the top of the box in 2013. Same can be said for Q1 of 2018 and here in 2021. This looks significantly different, seems to align with the concepts presented here, which you can find on our website. The concept of a demographically driven secular bull market that we covered in this June 16th video, and the fact that stocks are now leading relative to bonds also aligns with the secular shift in interest rates that we covered in this June 23rd video. You can find all of this by Googling the titles and our name, Shavako. It's also noteworthy that we broke out above an important VWAP level here, consolidated for the most part above that level, and appear to be holding at that level. If we were to move into this area here, we would learn something about increasing bearish probabilities. And that may happen very, very soon. It hasn't happened yet. Similar concepts here, a long-term period of confusion and consolidation. In this case, economically sensitive semiconductors outperforming the VEU chart that we just covered. It's probably noteworthy that highly economically sensitive semiconductors are even better. Long-term period of consolidation. This looks like a bullish breakout and consolidation above the breakout level. Earlier this week, the ratio SMH to VEU was above the 20, 50, 75, 100, 125, 150, 175, 200, 225, and 250-day moving average, and it is noteworthy that the slowest moving average, the 250-day in black, is on the bottom. Contrast that with blue, the fastest moving average, right up here near the top. VGK, European stocks relative to the equal weight S&P 500. You can see Europe was underperforming for a very long period of time. This is 2008 up here. We've recently breached the downward sloping trend line. What once acted as resistance may now act as support. What once acted as resistance may now act as support. So far, that bullish breakout is holding. We'll learn something either way. Looks a little bit more vulnerable, but thus far, global stocks, VT, all of this is occurring above an upward sloping 200-day moving average in red. Very similar concepts here. This is your bullish breakout, a very important breakout. So far, it looks like a retest. Not making any assumptions about what's going to happen next. So far, the bullish breakout is holding above the anchored volume weighted average price line tied to the 2021 high, in the AVWAP line tied to the October 2022 low, as well as those lines tied to the COVID high and COVID low. And all of this consolidation in recent weeks and months occurring above an upward sloping 200-week that we recaptured in 2022. Fed's raising interest rates and growth VUG underperforms SPY. That reverses for the most part at the exact same time that the NASDAQ bottoms. This looks like a bullish breakout and consolidation above that level. Again, all of it occurring well above an upward sloping 250-day moving average, meaning even if the ratio gets into this area here, we would still give the uptrend the benefit of the doubt. You can also make an argument that this is an upward sloping consolidation pattern in terms of psychology, some of the characteristics of a left shoulder, a head, and a right shoulder. Communications services, a big laggard in 2021-2022. Notice when it dropped below the 50-month moving average, the only thing that happened was the 50-month flattened out. Never rolled over. Prices recaptured it, and now the slope of the 50-month is trying to turn back up. It would be even more constructive if XLC can print a higher monthly high above this level here. You may remember we talked about XLC breaking out using this chart. This is May 11th, a chart that we've shown in the past. You'll notice price here around $59 a share. On October 11th, it was trading at $68 a share, meaning the positive developments on this chart that occurred after May 11th, they still apply. When you look at this chart, think about what once acted as support may now act as resistance, and what once acted as resistance may now act as support. This goes all the way back to calendar year 2001, where this red arrow is here. This is 2004. This is 2007. 2018. This is the COVID plunge here. And thus far, this consolidation is occurring above this level and above this level. And we're still hanging around an upward sloping 200-week moving average in red. This is XLF, the financial sector of the S&P 500. XLK relative to SPY, very similar to VUG relative to SPY or VUG relative to VTV. It underperformed when the Fed was raising interest rates. Things started to change early in 2023. Now it looks like a very long-term period of consolidation, a bullish breakout, consolidation above the breakout levels, all of the consolidation occurring above an upward sloping 200-day moving average in red. So even if this ratio comes down into this area here, still would be holding above that upward sloping 200-day in red. And all of the improvement has come since May. We haven't lost any of that yet relative to this ratio. We've covered this concept in the past. XLK relative to SPY monthly. This looks like a trend that got extended from the long-term moving average, came back to the moving average, and now has gone on to print a higher high above these levels. All of it occurring above an upward sloping long-term moving average on the monthly chart. Defensive XLP relative to SPY. This is increasing fear. The S&P 500, for the most part, peaks right here in October of 2007, when really bad things are happening. Think Lehman Brothers in 2008. The ratio is rising rapidly, and it's occurring above an upward sloping monthly moving average in blue. Compare the look in the present day. This is an increasing fear look in 07, 08 to the present day look, which is hard to make an argument that this is not a decreasing fear look. Slope of the moving average down, ratio below it. Slope of the moving average up in 08, ratio above it. There's a monthly version, weekly version relative to the 200-week here, major low 2016 in the S&P 500. Here's your COVID low. This is what happens. This is what's happened in 2023, and this is what we look like this week in October of 2023. Semiconductors, for the most part, look better than XLK. XLK, for the most part, looks better than QQQ, and QQQ, for the most part, looks better than SPY, and SPY, for the most part, looks better than VEU, and VEU, foreign stocks, looks better than XLP defensive staples. Here's your risk-off look here, the flip. You can see the ratio, quick spike up above the moving averages. Blue, the 20-day moving average, kind of shoots up here, and look what happens in the S&P 500. Present day, blue is on the bottom, the slope is down instead of up, and price is shooting rapidly below it. Probably fair to say this look here really doesn't look anything like this look here in December of 2021. Defensive staples relative to a leading sector, XLK. Tech stocks. Moves away from the 200-week moving average. Good things happen in the S&P 500 in 2016. Probably fair to make an argument that this look here in 2016, after that, good things happened for quite a while, almost a year plus. This looks similar to this period in here. All of this recently occurring below a clearly downward sloping 200-week moving average in red. This is the look that we covered back on May 18th. This is an improving bullish look, and it looks even better today. It has not been deteriorating. Economically sensitive XLY, consumer discretionary XLY in the ETF world relative to XLP that we've talked about numerous times, defensive consumer staples. Long-term consolidation pattern. This is risk off in 2022. Let's call it a left shoulder-ish over here. This is your head. This is maybe your right shoulder. Everything that's been happening recently with the S&P 500's weakness, for the most part, this ratio, instead of falling, has been moving sideways. XLY divided by XLP this week was still above an 8-day moving average in blue. We wrote about the improvement in XLY in isolation in this article here, dated May 30th. You can find it Googling the title on your screen. Last name Shavako. This chart was in that post. It's hard to say that we've given back that improving look. It's down here where the cursor is flashing. And if you want some assistance with the pattern visual, anytime you get a consolidation pattern and your neckline or your pseudo neckline is upward sloping, that tends to lean bullish. Conversely, if it's downward sloping, tends to lean bearish. The pattern in isolation doesn't mean a lot, but when you take everything else that we've talked about, the weight of the evidence, and you think of the psychology behind this type of pattern, it aligns with the weight of the evidence rather than contradicting the weight of the evidence. A lot of different ways to think about this, a lot of different ways to flip the ratio. XLY divided by XLP, risk off in 2007. 50-month moving average is rolling over in 2007. The ratio is well below it in January of 2008, relatively early in the financial crisis. Looks a lot different relative to the movement that we've seen since Q4 of 2022. So far this month, XLY is outperforming XLP. From a technical perspective, there's fairly significant damage in numerous markets currently. Thus, if things can't improve between point A and point B, the odds of this being a failed bullish breakout would increase significantly. And we have to prepare for that, and we will prepare for that. And we will respect all of this, but we'll also respect that the primary trend remains positive. And this data tells us the primary trend is positive, the long-term primary trend. 2 Fed communications this week, including the one in the Wall Street Journal, that for the most part are signaling to the markets that their rate campaign is over, or the odds are extremely high that it's over. The shelter component of CPI has been a problem. That's starting to improve, and the markets have been hyper-focused on interest rates. It's possible with earnings season already in swing that focus will shift away from interest rates to earnings. And since we may be nearing the moment of truth, it's extremely important that we don't make any assumptions about any topic on any time frame. You have to take it day by day and remain open to a wide range of outcomes, from wildly bullish to wildly bearish. It's important that we take it day by day while remaining open to a wide range of outcomes, from wildly bullish to wildly bearish. How is it easy to keep an open mind about wildly bearish scenarios? A breakout of this magnitude failing is really all you need to know. And that may indeed happen. It absolutely hasn't happened yet. If the message from the charts and the data shifts, we have to be willing to reassess the probabilities. During periods of high volatility, it's good to keep in mind, during a secular trend, our objective is to get to the right side of the table. Our time frame is not intraday for 2 or 3 weeks. If the data allows, as it does currently, we want to give the primary trend the benefit of the doubt. It's possible that could change, but it hasn't changed yet. With the S&P 500 hovering above a very key band of potential support, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.